In this video, I'm going to be breaking down the Asian session liquidity, the Asian range strategy, a couple of examples that I'm going to be showing here on the charts. So let's get into it. We're going to be looking at GBP CAD this week on Thursday. Understanding the Asian session liquidity is very valuable or very important when you're trying to learn how market makers move the markets, how smart money, as some people call it, institutional traders, move the markets, and it can help you get pretty accurate results and pretty sniper entries. Basically, you can have trades with zero drawdown and very close to the reversal point of the market. Now, in this example, what we're going to be looking at here is the Asian range. As we can see, this is the Asian range here, and we can see that the Asian range here is about 27 pips, which is very good, because we want the Asian range to be less than 50 pips, to be 50 pips or less, right? So this is 27 pips, as you can see here. So also you can also measure this and see that this is about 27 pips accurate. Now, when we're looking at this, if we're looking for sells, we're going to be looking for sells at the highs above the Asian range, above the high of the Asian range. And if we're looking for buys, we're going to be looking for buys below the low of the Asian range. So we're going to be looking for double tops or double bottoms, M or W formations, head and shoulders. In this example, they gave us sells, which is this M formation you can see here. I'm going to be breaking it down. Now, we see that the Asian range has formed here during Asian session. What do we have? We also have a tiny bit of consolidation right here at the middle of the range, right here, right? You can also draw this. This can be your Asian box. This is about, let's see, you can reconsolidate your box to be about, let's see, 14 pips, right? So you can reconsolidate your box from about 2 or 3 hours before the session closes. You can reconsolidate your Asian box. Now we can see that the market breaks out of that Asian box here with how many candles? With about 3 aggressive candles. So this is the first aggressive candle, then the market kind of stalls and then bursts out one more time, and the third time bursts out up here. Now, what do we have? The market breaks to the upside. Market breaks to the upside and comes back down and pulls back for about 20 pips. Now, what happens? The market pulls back for about 20 pips. What you do is that you draw your, this is the high of the day, right? So this is the new high of the day here. So you draw your line, draw a horizontal line at that high of the day, or you can draw a box, right? Draw a line here and also draw a line at the close of the candle, right? At the close and open of this candle here, from the body to the wick, basically, from the body to the top of the wick. So you draw that box. You can also draw it with your rectangular box like this, right? And then you can see that the market pulls back and begins to consolidate for about, let's see, for about an hour and 45 minutes. Then what happens after that? The market goes back to that box and retests the box here. And what happens? When the market retests the box, it gives us a rejection in the form of an inverted hammer. This is an inverted hammer. Let me see. This is an inverted hammer, something like this, right? A normal hammer is something like this, right? So this is an inverted hammer. Now, if you want to be aggressive, you can enter here on the sells, because the market, what basically happens is the market goes back, takes out the liquidity, also opens the spread, takes out all the orders in here, right? And then goes back down. We can see here the market comes back the third time, and now this is where you see your equal highs being taken out, right? So you can see the equal highs are taken out as this liquidity hunt here. So you can basically enter here on the reversal candlestick, or you can enter here. If you enter here, what I normally do is I put my stop loss 5 pips above the high. So if you put your stop loss about 5 pips above the high, you wouldn't have gotten stopped out, because you need, sometimes if you're putting your stop loss, you need to give room for your stop loss about 5 to 10 pips or 7 pips, right? Because sometimes they do this 3 hits. They might give you an information like this and then come back and stop on it one more time, right, before they make their move, right? You can't predict if they're going to give you this third hit, but you can enter on the second hit. You can, if they give you a third hit, that's even better, right? So you can enter either here or here. You can see that the market goes down immediately after your entry here and goes down, gives you about a 90 pip, 80 to 90 pip move, right? Yeah, so this is another example. Here we can see the Asian box here doing Asian session, and then The Asian box is about 21 pips. As you can see here, 21 pips. You can withdraw your box at the middle of the box here, right? So this is your new Asian box somewhere in here like this. And you can see the market breaks aggressively to the downside. And this break, remember the stop, if you're looking for buys, you want to buy down here. If you're looking for sells, you want to sells up here, right? And an ideal area of the chart where you want your buys or sells is from 25 to 50 pips below the box or 25 to 50 pips above the box. So 25 to 50 pips. So from here to here, that is about 25 to 50 pips, right? Same thing for the upside if you're looking for sells. Now we have this move down here, because why it's 25 to 50 pips below or above the box is because of that's usually how retail traders put their stop losses, is from 25. The majority of the stop loss is usually from 25 to 50 pips, right? So that's your stop on zone, or that's your stop on area where you can look for the M and W formations, because the market goes out to take liquidity. So this is the high liquidity zone here, 25 to 50 pips away from the box. Now sometimes they won't go 25 to 50 pips away from the box, but it's ideal and it's better when it goes 25 to 50 pips above the box or below the box. But you can also get something like this, maybe just above the 25 range. So now what happens is the market goes to that box, and then the market breaks aggressively, and then sets the low of the day here, right? Sets the low of the day here. You draw your line. You draw your horizontal line like this from the body to the wick, right? And then you can expect this is your zone. You can expect the market to go back and retest that zone. Now, as the market goes back to retest the zone, what happens? The market breaks below the low of the day and enters back in. What does that tell us? That tells us that this is a liquidity hunt. This is a stop hunt, right? So you can enter here on the close of this green candle, of this blue bullish candle, or you can enter maybe on the pullback of this red candle, maybe somewhere in here. But what happens now is you can see the market begins to consolidate after your entry, after the second leg here, and then what happens? It gives you another stop hunt, right, outside this consolidation. You can see that this is the same concept with this consolidation here, breakout and reversal, right? So you have your consolidation, you have your breakout, you have your reversal, right? So that's the same thing that happens here. Consolidates, break to the downside with an aggressive candle, and then goes right back up. Gives you a railroad track or engulfing candle. Your entry is here. You can see zero drawdown if you entered here on the third hit. This is about a zero drawdown entry, and gives you about 65 pips on this move. Now, if you entered here or if you entered here, you're still good. One thing you have to keep in mind is that if you enter on the second leg, you have to count about 2 hours. If you're not in profit and after 2 hours, then you're meant to scratch out and close your trade. And then if you start to count that 2 hour mark, if they give you another leg, you start to recount, you restart the clock basically. So if you entered here and you counted 2 hours, you can see right about here when they give you the third leg, it's about 1 hour 30 minutes. So by the time they give you the third leg, you restart your clock, and then you can see in about 45 minutes you're in profit, and then the market goes all the way up to your take profit. Another thing to notice is the market goes back up here to take out the liquidity above this area. Also, one thing to notice is, let me just delete this. If you look at your TDI or your RSI, basically, you can see that this is divergence. You can see that here the market doesn't go lower. So you have your first leg here, and you have a second leg, and your second leg is above the first leg. But if you look at price, you can see that you have your first leg here, and you can see that the second leg is below the first leg. So that is divergence. That means that because the RSI prints based off of the closes of the candle. So what is basically happening is the market is having higher closes, right? But it's showing lower highs and lower lows. It's showing lower lows on the chart, but it's averaging higher closes, right? So that's why this is higher than this, right? So that tells you that the market is about to reverse, that this is a stop hunt. That indicates your stop hunts, right? These two areas here are stop hunts, right? You can even see that this is even aggressively, even the distance from here to here is even more than the distance from here to here, right? So Let's move on to the next example. So here we have the final example. It's basically the same thing, but in this example, we have stop on to the downside and to the upside, right? So here we have a stop on to the downside. This is our Asian range, and our Asian range is about 28 pips, which is ideal. Then what happens if you reconsolidate your box? You can see we can reconsolidate your box here. And then what happens? The market breaks to the upside, here to take out breakout traders. People take breakouts here, buy here, right? And then London open right here. This is London open. The market comes to the downside, takes out liquidity at the downside. And if you measure this, I'm not sure this is an example where the market just goes to about 19 pips or 20 pips, right? Doesn't reach the 25 pip mark. But you can see that the market goes down here and then pulls back up, begins to consolidate. Now, if the market had gone back down here, that would be very good. That would be your second leg, right? And then you basically enter this. But in this scenario, they didn't give a second leg, right? So now the market goes up 1, 2, 3 to the upside, and then comes back down here. Also comes back down to retest the high of the Asian range, breaks it and goes back up, right? And then what happens is you draw your line, your horizontal line here, and draw your horizontal line here like this. And then what do you have? We have this zone where we expect price to come back to. Now, if the market goes back to this zone, you can look for your entries. Now, the market goes back up here, stop on it, right? So how do we know this is a stop on? If we look at your RSI, you can see that price is giving you higher highs, but price is giving you lower lows, lower highs here, right? So this is your divergence. This is your stop hunts, right? The market is stop hunts in this area, taking out the liquidity all the way up here. Now, after this candle, you can enter on this red candle after the stop hunt, or this red candle after the stop hunt, or basically this would be a late entry, but this is also a good entry. You can enter anywhere in here, right, before this fat candle goes out, because by the time this candle comes down here, your entry is already late, right? Your stop loss is going to be too big, right? You're going to have about a 35 pip stop loss. But if you entered here, you can have about a 20-25 pip stop loss. If you entered here, even better, you can have a 15 pip stop loss, right? So if you entered here, basically put your stop loss above the highs. You can target probably this area here, right? Because there's going to be liquidity down there. You can target this area, or you can close. Maybe if you're going for a 1 to 2, you can go for a 1 to 2, or anyhow you want. And even if you even notice, the market even goes down even more and more, right? And one thing to note about this setup is that this is like my favorite setup, because we have the high of the week here. You can see this is Wednesday, Monday, Tuesday, Wednesday. We have the high of the week, and the market gives us an M formation at the high of the week. So what is basically happening is the market is stop hunting this high of the week, and also giving us an M formation with a stop on. So this is the second leg of a second leg. So this is the first leg, and this is the second leg that has a second leg, right? So this is your M formation like this. And on the second leg, you have a second leg. That's a very beautiful setup right there, right? And you can see the market continues down for about 3 days and then reverses back up, right? So also, if you look at this, you can see there's also divergence from this leg to this leg. Let me just clear everything out. You can see there's divergence from this leg to this leg, and from this leg to this leg. So that tells us that this whole thing here is a stop hunt, right? You can see how everything comes together in perfect confluence, right? So this high, also this high, and this high. Everything is at the high of the day, high of the week, right? And then M formation with a micro M formation, and then the market goes down, right? So if you found this video helpful and informative, click the like button, subscribe to the channel, and I'll be uploading more of this type of videos, and I'll see you guys on the next one. Peace.